Hello, everybody. Good afternoon, and welcome to another installment in our ENS Africa CPD Masterclass series. For those joining us for the first time, and I acknowledge that we have many people who've joined us for all the series that we've presented to date, and welcome back to those people. But for those joining us for the first time, my name is Jessica Blumenthal, and I'm a director in the Banking and Finance Department at ENS Africa, based in Cape Town, South Africa. For the last 3 years, we have presented these CPD webinar series, and we've done so for our clients in the financial services sector who are required to undertake continuous professional development within the CPD cycle ending at the end of May. And for the last 2 years, we've been using this opportunity to really further the conversation around ESG and sustainability and the various different aspects that fit in under that umbrella or banner heading. And what we've done this year, which has been perhaps a bit different from last year, is to bring together panels of experts to present something a bit more deeper than an introductory continuous professional development session, but rather what we like to think of as a masterclass on some of the emerging risks that are facing us as a global community today. So this is the 11th installment in our series, and we do still have a few more. We have 16 masterclasses in total, so there are 5 left. So this is an invitation to everyone who's joined us today. If you still need some more CPD hours, or even if you're just intrigued by any of the upcoming topics, please do register and join us for those as we finish out the month with the last 5 sessions. Then if you are joining us for a CPD certificate, then please just a reminder that we do verify attendance before we are able to issue certificates. So you will need to stay online for the full hour of the presentation. And once our team's been able to verify that, then they will issue the certificate to you within 2 or 3 days after the webinar. You are able to ask our panelists questions as we go. To date, we found that we have so much to get through in the panel that we've sometimes struggled to get to the questions, but please do share your questions with us. You can use the Q&A button at the bottom of your screen. And if you post your question there, even if we don't get to it during the panel discussion, the panelists will pick your question up with you over email separately. Of course, you're also welcome at any time to email our panelists and to keep the conversation going with them after the webinar has been presented. And finally, if you are able to join us, we are having a cocktail function in both our Cape Town and Johannesburg offices to round up the series once we finish at the end of the month. And that's a great opportunity for us to meet you in person, and also for you to ask questions of the panelists in person and to get to meet them and interact with them. So we do encourage all of you who are able to join us at either of those cocktail events. So then on to today's panel. I'm very happy to welcome onto the panel and onto the screen in the next few minutes a multidisciplinary and a multi-jurisdictional panel today. We have Binti Shah, who is an executive in our banking and finance team working out of our Kenyan office. We have Jordan Mays, a senior associate in our banking and finance department working in South Africa, and Colin Fratelli Davis, who is a member of our natural resources and environmental department, also working in South Africa. In addition to their different practice areas, each of Binti, Jordan, and Colin are also members of our ENS Africa ESG practice group. And for those who, as I said, are here for the first time and haven't heard this before, the ESG practice group is a collection of practitioners from all the different practice areas and also sitting in our offices throughout Africa. The idea behind the group is to bring together a diverse perspectives at least, allowing the group to consider ESG and sustainability related issues holistically, such that we are able to offer innovative solutions and strategic guidance, which is founded really in our local knowledge and experience to the problems facing our clients today. So by way of introduction, today the topic, as you've seen from the invitation and from the heading, we are going to be discussing the risk of greenwashing in the bond market. And of course, greenwashing risk is more prevalent than this. It's not only in the bond market, it should be on the risk register of all firms in all sectors, but both internationally and locally, the bond market, initially representing the lion's share of sustainable finance, has been in the spotlight and faced early criticism in this regard, and hence we're focusing on it today. As interest in sustainable finance grew in recent years, issuers rushed to issue green, social, and sustainability-linked bonds. And so in the absence of initially of standards and parameters, these issuances were vulnerable to criticism. And what we're going to do today is essentially unpack the greenwashing risk. And then my panelists will share with you their experience in both the bond market and in respect to greenwashing. And we'll try and share some ideas and thoughts with you. So to kick us off, I'm going to go first to you, Jordan, and ask you to just sketch for our attendees the difference between a use of proceeds bond and a sustainability linked bond.
Thanks very much, Jessica. To be brief, a green bond is essentially, as you mentioned, a usage-linked bond. And the move towards ESG compliant debt started with what's known as a green bond. These instruments have been around for much longer than sustainability-linked bonds, which are relatively new instruments, with the first green bond being issued around 2008. Yeah, as the name suggests, a proceeds usage-linked bond is precisely one that is linked, where the bond is issued specifically to finance projects that have a positive environmental outcome, such as a renewable energy or relating to sustainable infrastructure. The African Development Bank, for example, recently issued a 200 million rand green bond in support of green financing in African countries. And so the funds raised through this transaction are to be used to finance eligible green projects in supporting African countries. But what about companies that can't raise money for a specific purpose because they don't plan on using it for a specific green project? And that's where sustainability-linked bonds come in. With sustainability-linked bonds, issuers can raise money for any purpose, but it becomes ESG worthy by the issuer tying the bond's interest rate or the coupon to its achievement of broader sustainability goals, such as achieving certain sustainability performance targets or STPs, or other key performance indicators, KPIs. These bonds are, as I mentioned, tied to the company's sustainable performance, rather than being focused on the use of proceeds, as with green bonds. Sustainability-linked bonds then have a penalty or a reward system, depending on whether the issuer meets its targets or not. For example, where a company misses the mark, it typically has to pay a higher coupon or interest rate. And in the market, we generally see these as 25 basis points. And in the market, there's not really a penalty hike of about anywhere near 100 basis points at the moment. As I mentioned, sustainability-linked bonds are relatively new in comparison to green bonds. The first sustainability-linked bond only entered the market in around 2019. And some consider that sustainability-linked bonds are a natural evolution from sustainability-linked loans, which are, of course, private documents rather than public bonds. A recent SLB that was issued was in August of 2022 by Anglo American, where they issued their first sustainability-linked bond. This was tied to its performance targets to reduce greenhouse gas emissions, fresh water abstraction, as well as to support job creation in host communities. Where these are not met, bondholders are entitled to a higher coupon payment. And this is a coupon increase of around 40 basis points, depending on whether these KPIs are met or achieved. The market globally has seen, as of September 2022, the cumulative green, social, sustainable linked bonds has topped $3.5 trillion US, with green bonds making up over half of these in value, whereas sustainability-linked bonds making up a mere 5.5%. So it's still a growing market. Since the first green bond was issued in 2012 in Africa by the IDC, priced at around 5 billion US, the green market has risen to over $33 billion as at the third quarter of 2022. Again, green bonds remain the dominant theme here, making up over half of the cumulative volumes, compared to sustainability-linked bonds, which hold the second largest share at 23%. So the market is growing, and as investors become more ESG conscious, I think the market will only increase.
Thanks, Jordan. And I guess why this is a vulnerable market from a greenwashing perspective is that there is a financial incentive to either raising a use of proceeds bond for a particular purpose that can be labeled as green or social, or for enjoying a margin reduction if one were to, in a sustainability linked bond scenario, meet the sustainability performance targets and KPIs that you've indicated. So where there is a financial reward on the line, then of course there is a vulnerability to greenwashing. And so these issuances this is a risk associated with these issuances. So Colin, I'm going to ask you to take us through what is greenwashing, and what are the ways in which this risk could be managed.
Great, thank you so much, Jess. So greenwashing, for those who aren't aware of the concept or the term, it merges two terms, namely green, being environmentally sound, and then obviously whitewashing, which is to conceal or gloss over wrongdoing. And there's also something called ESG washing as well. So this is broadening. And when we look at a more technical definition, it's basically a form of marketing or public relations that links an organization to positive association with environmental or social issues, but for an unsustainable product or service or practice, which wrongly leads the public to believe, maybe in another example where one product or one service is fairly green, but the way it's marketed, it's believed that the company as a whole has products and services that are green in nature. So generally, it's just an unsupported or selective misrepresentation that misleads consumers and investors. And so often what we suggest for consumers or for companies to look at is to ask questions like, is the statement aspirational? And is it not likely to deceive? Obviously, will it be relied on by a reasonable consumer? And is it a deceptive statement related to a verifiable fact? So it's quite important that any statements that are released relating to ESG, sustainability, anything like that has facts to support it. And so it's obviously in this age where consumers and investors are far more educated, it's really important to ensure that any aspects are supported by the correct information and facts. And there are quite a few different types of greenwashing at the moment. The most important one for the bond market, I would say, is labeling. So that is specifically overstating ESG or sustainability facts about the nature of the fund and the product as a bond. And so it's important when you look at that to determine a bond and how you obviously relay the information about it. Is there screening or selection of the financial value of the entity's exposure to sustainability, whether it's positive or negative? That's often linked to sustainability, where it's positive and negative impacts from an environmental, social, and corporate governance perspective. And then another approach is where it's aimed towards the sustainability impact goals. So those are just two different types of investment approaches that you can look at with labeling. And again, it's important to go to the facts. And we have got some examples. As Jordan said, green bonds came out a while ago, but in 2017, Repsols, they issued a green bond, and it was linked to, when it was their first green bond, but it was linked to an oil and gas company. And then there weren't necessarily any guidelines, and they were obviously very negatively portrayed because of the fact that oil and gas company is not necessarily linked to green or sustainability. And there's another example in Japan. They had, there's a company called Energy Tracker Asia, and there they used the proceeds from a transition bond for projects again linked to a gas company as well as a company that was the largest emitter of CO2. So there was already some abuse, and I think it's important, and there will be guidelines going forward relating to that type. Then just to go quickly into two other types, but I think they speak more to broader ESG and sustainability claims. But there is also physical greenwashing linking to physical activities. So this often links to taxonomies, which we aren't dealing with here. But a good example is Volkswagen, where they obviously had their lower emissions, a software to determine lower emissions. And then it was later found out that that software only operated when it was being tested, but when it was driven on the road, then it didn't kick in. So that's misleading, obviously, from a physical perspective, because the software tried to avoid or tried to mislead consumers about the impacts of CO2. And then there's also disclosure. So this is the more traditional greenwashing, which is normally a fact, especially confidential, which is made known, and it's used to persuade consumers, obviously, to buy a product or use a service. And there again, focusing on the banking sector, we had Deutsche Bank, and they had a raid to investigate their misleading statements in 2020, where they reported that half of the group's $900 billion assets were invested using environmental, social, and governance criteria, when in fact that wasn't the case. So as I mentioned already, disclosure, it's really important that it's supported by factual evidence and not just aspirations. And then that leads to the risks that are associated with greenwashing. Obviously, the most important, I think, at this time when this is all fairly new in the market is reputational, and that can ultimately impact on share value. And then from an internal reporting perspective, when it's a company dealing internally, again, it's important to track any data that is disclosed to third parties or to the public, track it through data management and obviously KPIs, which I think we'll deal with in a bit more detail later. And then from an external perspective as well, there are ways in which companies can protect themselves, especially when greenwashing may be from a supplier or a third party or a customer. And obviously, to protect the company in that instance, you can manage your risks through clauses in the relevant agreements. And we're seeing a move also towards due diligences of clients, which I think will become bigger. Thanks.
Colin. And you actually brought us perfectly to the next question, in that you've mentioned clauses in the agreements. And I think, Jordan, let's just, being all of us on this panel being lawyers, let's take it down to the specifics. Can you talk to us a little bit about some of the common provisions which are being included and developed in the program documentation for sustainable bonds, both in the to address this risk and to ensure that the product is actually what it holds itself out to be, to address these general risks that Colin's been talking to us about?
Of course. We're generally guided by the ICMA, the International Capital Markets Association, and they've helped us and helped the market by providing principles in 2021 to guide companies on considering to issue sustainability-linked bonds. And these principles help and aid us in avoiding potential greenwashing claims when preparing these program memorandums. These principles stress a few things, but most importantly, I'd say they talk about having clearly defined, measurable, and verifiable KPIs and STPs. And that these STPs and KPIs should be in line with global standards applicable to them. They should also be relevant, core, and material to the issuer's overall business. All of this is done so that it avoids these KPIs or STPs being seen as vague or ineffective. Another important principle that we often find in these program memorandum documentation, and is guided by the ICMA principles, is that when you set targets for your KPIs, that these need to not be considered as business as usual targets. It needs to be shown that the company is doing something and that they are being ambitious and that they're setting these targets in good faith. In other words, these targets should result in a material improvement in the KPIs. And often these targets, we see in the market that there are benchmarks, not only against the internal performance of the company or the group over the past years, but also externally, looking at competitors in the market and other external references to make sure that the impact is actually a substantial one and an effective one when looking at ESG. It's also important in our program memorandum documentation that we have clearly defined methodologies for assessing performance so that it also is in line with global standards as these develop. One of the provisions that we're often seeing, and one of the important steps that we find in the issuance of sustainability-linked bonds, is that there's a second-party external opinion issued prior to the issuance of the SLB. And that opinion looks at, as I mentioned, whether these KPIs and SPTs are indeed defined clearly, measurable, verifiable, are they benchmarked, do they actually have a positive impact? And so these external opinions go out prior to the issuance, and that helps guide the investors and make it clear what the purpose of the bond is and how it will achieve those targets and how to calculate those targets and assess the performance on an ongoing basis. Looking at particular clauses, there's in sustainability-linked bonds, there would be what's known as a repeating representation. And we're finding it in the market that generally it's a representation that all sustainability information that has been provided is complete, true, accurate in all material respects on the dates which is provided, and it's not misleading in any respect. What is that sustainability information? Well, in SLBs, the market generally, we see that there are information undertakings or reporting requirements also included in the documentation, and that these reports are accurate and verified. Generally, we also find that these reports should be provided at very least annually and should relate to the performance of the issuer or the group and how they are performing and tracking against their KPIs and SPTs. And typically, these are also coupled with an external or third-party report verifying the report provided. And the intention of these reports is to keep the note holders up to date on the information relating to the KPIs in a sufficient way so that the note holders are able to monitor and assess the ongoing performance of the company against its SPTs.
So Jordan, I mean, you've mentioned having SPTs and KPIs as a parameter or framework against which to test performance. And you've mentioned the objectivity requirements, external validation of those. But presumably that presupposes that the SPTs and the KPIs are set appropriately and not, as you called it, business as usual. Would you say that having weak or ineffectual SPTs or KPIs could, in a sense, also amount to greenwashing?
Of course, where an investor is looking to invest in a bond under the impression that the bond is indeed achieving a certain goal, where those goals are vague or unambitious, where they're coupled with targets that aren't sufficiently material, could arguably be that the issuer is misleading the investors into thinking that the company is in fact committed in a meaningful way to sustainability, when in reality the company may not be doing much to address its environmental impact, and it may be, as I said earlier, business as usual. This comes about especially when looking at the cost of sustainability-linked bonds in contrast to conventional bonds. Generally, issuers of sustainability-linked bonds pay a much lower coupon than you would normally see under conventional or non-green bonds. And so there's an incentive, so it shows that the company themselves are saving money and also marketing themselves in a way that they're not indeed achieving the meaningful goals at which they should be by marketing the product as green. Weak or ineffective SPTs and KPIs. As I mentioned earlier, it's important that these are relevant, core and material to the issuer's overall business and not business as usual. And in some cases, we've even seen in the market where KPIs have already been achieved prior to the issuance of the SLB. This was the case with the fashion giant Chanel, who recently issued a 600 million euro SLB, which included as a KPI that they cut 10% of their indirect or scope 3 emissions, which are essentially the emissions produced by its suppliers and customers, and that they dropped this by 10% by 2030. And as with SLBs, it included a coupon hike if the KPIs weren't met. However, when examining the Chanel deal, it was found that in fact the company had already fulfilled this key objective before it even sold the bond to the investors. By the company's own disclosures, it was shown that by the time the bond was issued, the emissions had already fallen below 21% of the baseline set in the program memorandum. So it's not only weak or ineffective, but it's an argument that Chanel was essentially getting to pay its lenders a lower rate for meeting a goal that it had already succeeded in achieving. And that in doing so, it was also paying a lower coupon than it would under a conventional bond. In the market generally, sustainability-linked bonds issuers are becoming increasingly exposed to greenwashing claims, either in their ability to prove their claims and what they say about ESG, what they're doing about ESG. And this is becoming more and more so as the ESG environment is evolving over time. The risk of allegations of greenwashing will only become more prevalent in the market as there's more regulatory clarity and coordination internationally on what ESG reporting standards are, what the global market standards are. And as these are developed and clarified over time, I think it's highly likely that these allegations of greenwashing will only increase.
Thanks, Jordan. And I think you've really put your finger on one of the main issues with the market, in the sense that we want sustainable finance to be a lever for real world impact. So if sustainable finance flows are being funneled through instruments where actually the impact has already been achieved and therefore need not be incentivized, or where no real world impact is actually being achieved by the incentive of that lower cost of capital, then we're not getting to where we need to be in terms of actually addressing the issues that need to be addressed. But then, we've been talking about the risk for issuers, and we've been talking about whether either a green bond or a sustainability linked bond is an appropriate instrument. And Jordan's taken us through some of the additional provisions included in those documents in order to ensure that they can adequately fit under those labels of green or sustainability linked bonds. From your experience, can you share with us some of the difficulties that you've seen in practice for issuers in actually making the repeating representations required of them in terms of the ICMA principles that Jordan sketched?
Sure. Thanks, Jess. Yeah, you're right. In Kenya, like in most other jurisdictions, basically, an issuer has to make representations before it can issue the bond and also after. And then once it's issued the bond, there's also continuing disclosure obligations. So for a green bond to be listed in Kenya, you need to comply with the Nairobi Securities Exchange listing rules. So the first thing is to determine whether your project qualifies as a green bond. And to do that, you need to conform to the green guidelines and standards. So these basically are the ones that import the ICMA principles. You could also comply with the climate bond standards, which again incorporate the ICMA principles. But we have other standards in Kenya as well that you could comply with. So we have the Kenya National Policy on Climate Change. You have the Green Economy Strategy, and you have any other standards acceptable to the exchange and to our Capital Markets Authority. It's lovely and wide. So basically that's our first hurdle, to complying with the ICMA principles. Kenya doesn't have a green taxonomy, so we borrow from others basically, and these others are not contextualized to suit Kenya. So they're quite generic and don't give the guidance, to a Kenyan market and to a Kenyan issuer per se. So that's our first hurdle. Our next difficulty is that there's so many guidelines that one needs to comply with that it becomes quite confusing and overwhelming for an issuer. It's an area of law that's so quickly evolving. There's more and more desire to also legislate all the time, provide guideline after guideline. You almost need a spreadsheet. In fact, you do need a spreadsheet and sort of ticking off all the requirements. And even then it's quite confusing. So that's another difficulty we have. I mean, once a project is selected, and I'm fairly certain it's quite easy to select a green project. I mean, we all live in Africa after all, and most projects are fairly green. The next hurdle we find though is it must be bankable. So speaking to many investors in Kenya, that seems to be an issue. Finding a bankable green project is not always as easy as one would expect it to be. So that's a difficulty that we've got to overcome. Another problem we face is the technical expertise, or rather lack thereof. And one of the pillars of the ICMA Green Bond principles is the pillar on the process for project evaluation and selection. So the guides, this guides issuers to basically on what they need to communicate to their investors. So, for example, an issuer would have to communicate what environmental sustainability objectives the eligible green project will meet and how it will meet them. So, for example, if the issuer intends to direct the proceeds towards construction of a green building, right, these objectives will be met by hiring expert contractors in the area, utilizing certain types of sustainable materials, avoiding non-sustainable mechanisms, right? So then the second question to ask is what procedure the issuer uses to determine how their project fits within any of these eligible projects as listed by the ICMA principles. So, for example, it might fit into clean transportation, climate change adaptation, green buildings, renewable energy, etc. So once you've done that, then you then need to identify, manage, and mitigate the perceived environmental risks associated with the project. So, for example, a risk that could manifest when constructing a green building relates to technology. So typically, green buildings tend to utilize the latest construction technology and innovative materials to achieve sustainability. So the issuer must be able to confirm that they have access to the technology, they have access to the expertise in terms of personnel who have the technical knowledge to use the technology and to produce the green buildings. So basically, technology is a big thing in this, and we're not necessarily all quite there. I suppose it's an area that there are opportunities to upskill. So basically, once that's done, the issuer has to appoint an independent verifier who basically carries out a pre-issuance review and confirms that the bond is classified green pursuant to the green guidelines and standards. So again, international standards apply, and any entity that is compliant with ICMA's guidelines for external reviewers would qualify. So again, the technical expertise is not in great abundance in Africa. Remember, Africa sort of lags behind by about 10 years to Europe and in the issuances of these green bonds. So I suppose, like I said, it's an opportunity to upskill, an opportunity to, create that type of employment, I suppose. But it's still a hurdle at this stage. Litigation is another issue that we've seen that issuers are now starting to bear in mind while making the representations in their bond documentation. Post-bond issuance, there's the risk that the issuer may have intentionally or unintentionally misrepresented certain facts. Perhaps, due to the lack of technical expertise, perhaps due to a desire to, possibly present themselves in a certain light when advertising, that they might, they might exaggerate some of their smaller green achievements, for example, to gain favor in the market. Ultimately they have to sell their bond. Perhaps it's due to a lack of sophistication on understanding the consequences of misrep. But nevertheless, it opens up the bond and the issuer to risks on litigation on multiple fronts. For example, consumer protection legislation, competition legislation. In 2021, our competition authority in Kenya has already warned businesses regarding use of labels like all natural, biodegradable, microwave safe, eco-friendly. Basically our competition authority stated that these businesses should ensure that the claims are not misleading to consumers, because if they are, they're in breach of our act, and there are particular provisions which state that a person commits an offense when they use false or misleading representations in connection with the supply of goods or services. Other breaches could be under capital markets legislation, Companies Act legislation, reputational damage, like Carlin said. Basically, it can come to you on so many different fronts, and across the globe, litigation on greenwashing is becoming more and more rampant, and it'll certainly be on the increase in Africa as we see more and more bonds. And before, issuers in Africa, being 10 years behind issuers in Europe, always look to that experience, look to see how the take-up has been, what the risks have been, etc. So we see this as a risk that they certainly have to factor in now.
And maybe perhaps one that's difficult to swallow when the financial incentive is not yet such that it's worth taking on this additional risk, committing to these additional representations and this external verification of your business operations, essentially.
Yeah, for sure. And it might be cheaper and in the long run, looking at all these aspects to do a sustainability linked instrument as opposed to a green bond, because you might not get hammered on so many fronts, but it's good to try and evolve the economies to be compliant, for sure.
Yeah, no, absolutely. And that's a problem we've experienced in South Africa as well, that the financial incentive just doesn't yet match up to the additional burden being taken on by the issuer in issuing such an instrument. And then perhaps just looking from the sustainability linked bonds again back to the green bonds or the use of proceeds bonds. And Binti, looking at the requirement to trace the proceeds, is that problematic for issuers? Is it something that you've seen different solutions develop around? Can you touch on that briefly?
Yeah, the main way that ICMA, certainly the ICMA principles and other guides trace proceeds is through the reporting requirement, on issues which remain throughout the life of the green project. Annual reports have to be provided, and these are again confirmed by independent verifiers. So yes, we have actually seen difficulties with reporting. The ICMA principles list what would be considered a green project, but they don't outline what use of projects will be considered green. So, for example, they state that renewable energy is a green project, But in order to, basically finalize the entire project, there may be some use of the funding that would not necessarily be directed towards the renewable energy production per se. So does the use of funding for elements that, of the project that are not green still fall within acceptable use of proceeds? So this analysis is basically left to the issuer, its advisors, and the independent verifier. So fine, they can come to a conclusion on if they think it's green or not, as the case may be. But upon submission of the report and assuming that they think it's green, then it's for the regulators to then take over and determine whether or not the proceeds will be considered green. So this we see is a risk because it's opaque, and it can be a dissuading factor for issuers who don't have clear guidelines on what is expected of them. Harlan gave various examples of different jurisdictions like Japan, etc., where proceeds were used for something else other than being completely green. I mean, there was also a big furore in China a couple of years ago when this green financing could arguably be used for working capital, but it meant that it was going to be used for coal projects, since these were part of the other projects the issuer was carrying out. So, we see this as somewhat of a problem. Other difficulties could be, literally the cost that we've gone over. It's expensive. It's expensive to upskill. It's expensive to get these independent verifiers, and the whole process of reporting is fairly expensive. The technical expertise or lack thereof, again, is another problem that we've already touched on. But we do see solutions. There is a lot of will in the world to get these instruments up and going, and it's good for the economies as well. So there are some potential solutions that we feel could be implemented, from the DFI space, for example. There's more grants, more subsidized facilities from DFIs to fund the tools basically to develop the reporting standards, because that's where we see issuers struggling. They need these tools, these, not just the expertise, but also in terms of even getting a report out, for example. What goes in the report, what format does it take, how do you do it all? So basically, if there's some sort of grant or subsidized facility, technical assistance, it would make it cheaper for issuers to report. Again, the DFIs are great at, capacity building, more education, all this helps. A solution we've actually, potentially got in Kenya, which is very interesting, is Kenya recently released a draft National Green Fiscal Incentives Policy Framework. Gosh, it's quite a mouthful. Basically provides for the development of a green investment bank whose mandate will be to support green growth. So through this, the bank would offer a range of financial instruments, including credit guarantees, risk reduction facilities, debt, equity, sort of all geared to supporting green investments. And then the bank would offer expertise and guidance on the issuance and development of these instruments, such as green bonds, etc. Again, it's a draft policy, but at least, you can see that the will is there to get these type of instruments going, to get in the assistance, and I think all over Africa. I mean, we're the next frontier where all these instruments can be done and done successfully with the right, with the right assistance. Another solution we've seen is more clarity. We need that clarity when it comes to the regulations that apply. For example, I mean, France has legislation specifically on greenwashing and what needs to be disclosed, so that terms like carbon neutral can be used, So that type of clarity in our legislation would certainly assist across Africa, I think, to avoid, greenwashing, really. so that we all know what we're angling for, what the parameters are. And I suppose it goes to what Jordan is saying, the KPIs and the, what needs to be met.
And Binti, from a taxonomy perspective, has Kenya got a proposal for a taxonomy or any work underway?
Not as yet, not as yet. We're borrowing at the moment. I think they're trying to, I think they believe that because we've borrowed and it's quite generic, I mean, we can have virtually anything that is remotely green because it allows, our legislation allows for anything really. It's quite flexible. They think it will encourage others to find some sort of green projects as yet. So we don't really have a green taxonomy. I think it would be useful to have one, maybe in the next few. Certainly something a lot are proposing, but
It's just
nothing
interesting. It's interesting to think about taxonomies and the role that taxonomies can play in trying to get some more clarity on what constitutes an eligible green project or an eligible social project. And I think particularly going to the example that Colin shared around the Japanese company, I think it was investing in the transition project, where there was uncertainty as to whether the particular project was acceptable within a transitional space or not. I think that's where taxonomies can really help us to get that kind of clarity. Obviously in South Africa, we've got our green finance taxonomy, but it still needs to be developed further to cover all sectors and to essentially be as widely drafted as will be necessary to be a completely useful document, but it's certainly a very good start. And we've seen in the sustainability linked loan and the green loan space an increased reliance on using the taxonomy where it can be used in a particular relevant sector as a starting point for setting SPTs and KPIs, or for deciding whether a particular project is an eligible green project or not. So I think that interplay is quite important and something that all of us can keep an eye on. So
I mean, in South Africa, do they actually just use the green taxonomy to the exclusion of ICMA or any other guidances, or is it a supplement?
It's a supplement, and it's because again, and I'm talking from a loans perspective, which is more my area than debt capital markets, but whilst there are principles, if we think of the LMA principles around a green loan, whilst there are principles as to what is eligible or not eligible, those principles are generic and then haven't been developed with reference to a particular jurisdiction. And I think that's where, if one looks at from a South African perspective as the South African green finance taxonomy, you think of a green building, for example, then it certainly gives more color to what is considered green or not.
Yeah.
So thank you very much to the panel. I think we've covered quite a lot of ground in this presentation, or at least discussion, not a presentation, as to the risks, opportunities, and difficulties with this market. And so we haven't actually received any Q&A in our Q&A slot. So I would like to really then just close up this discussion, ask if there are any closing remarks from anyone would like to make. No, all right, then thank you very much for the discussion and for stimulating us all to think a bit more deeply about this and to think about particularly the risk, Colin, that you highlighted from a greenwashing perspective, which is a more general risk than just a risk for the bond market. It's a risk for all entities making claims that cannot be substantiated. And Binti has highlighted some of the issues with the difficulty in actually substantiating claims and the lack of technical capacity to be able to do that. So that is something that's relevant to all companies in all sectors, and something perhaps for us to all think on. Just again, a reminder that we do still have several five, I think, masterclasses left in the series, as I said at the beginning. Please do sign up and join us for any of those if you'd be interested to do so. And then finally, I extend an invitation again to those who are in either Cape Town or Johannesburg to join us at our cocktail functions at either of our offices. It would be a pleasure to meet you in person and to further this discussion with you. Thank you, everybody, and we will see you again tomorrow. Thank you.